Hello everyone. I'll be discussing about the cost of new common stocks, composite or weighted average cost of capital, and the factors that affect the weighted average cost of capital. One of the goals in studying finance is to learn tools that helps us to make a better investment decision, and from a corporate finance perspective, the investment decision is whether we should build a new factory, whether we should buy some other company, or whether we should introduce a new product. So in order to make those decisions, we need to calculate the cost of capital. That is, how much is it costing us to finance this investment. So what is the cost of new issues of common stocks? So issuing a new stock of common stock is more costly than financing with existing shares. Why is that? So new shares are usually underpriced. They're sold at a discount, and by that they're sold below the market value. You can see that commonly in initial public offerings wherein private firm goes public, companies like eBay and Netscape. These companies may price out their shares at a specific amount, and that's the price that a mutual fund or pension is going to pay to buy shares of the stocks. But as soon as it opens an exchange, that price might shoot up. So why do they underprice? So well, it makes it easier for the investment banker to place the shares to have them sell to a mutual fund or pension. So one model we use to find the cost of equity is the Gordon growth model. So this is a model that prices stocks based on the assumption that dividends will grow to a constant rate of G forever, and it turns out that the price today is going to be the dividend one period in the future divided by the cost of equity minus the growth of rate of dividends. So if we are to rearrange the terms, we can solve for the cost of equity. It's going to be D1 over P0, which turns out to be the dividend which yields plus G, and turns out to be the capital gain. So if we want to figure out the cost of new issues of the common stock, we need to use this formula. So we need to modify the previous equation. This basically looks the same, but instead of calling it RS, we're going to call it RN, the cost of new issues, and D1 over N sub N instead by being divided by P sub 0 and sub N are the net proceeds that the firm received from issuing these shares. So another way is to look at the percentage of underpricing and flotation cost. So let's say that this turns out to be 10%. Then you take the 1 minus 0.10, or we take the market price value and multiply it by 0.90. So we would use the 90% of the market price as the denominator here to calculate the cost of new issues of common stock. So here is an example. So Duke Company expects to have a dividend of $4 next year, has a current market price of $50, and an expected growth rate of dividends of 5%. So find the cost of equity. So we use the formula $4 over $50 plus 0.5, and it turns out to be 13% or 0.13. Weighted average cost of capital, or WACC. It is a calculation of a firm's cost of capital in which each category of capital is proportionately weighted. It is a way to calculate the cost of capital for a company, to measure the required rate of a return of a company. Companies can use it to measure the profitability of a project. Investors can use it in something like discounted cash flow. It takes into account the cost of preferred shares, if the company has any, and the cost of the company's equity. Here is the formula to be used in calculating for WACC. As you may notice from the formula, there are two primary letters. W stands for weight and R stands for percentage cost, required rate of return. WD stands for the weight of the debt and RD stands for the cost of debt. So 1 minus T, and T stands for tax rate. This only applies to the debt because the debt has a unique feature of usually having interest payments that are tax deductible. This is a tax adjustment you're making to the cost of debt. So WP is a weighted preferred shares. RP is the cost of the preferred shares. WC stand for weight. RS stands for the required rate of return. An example. So the first question we tackle when looking to calculate the WACC is what percentage of that $100,000 is debt and what percentage is equity. So $30,000 debt over $100,000 in total market value tells us that the debt portion is 30%. Since in this case we have no preferred shares to consider, while the equity portion is 70%. If the cost of debt is 4%, then the debt is really quite simple to calculate. Then the cost of equity is 10%. So generally the cost of equity is higher than the cost of debt since equity shareholders bear more risk than bondholders, and therefore equity holders demand a higher rate of return than debt holders. So this can be thought as of what the equity investors expects to the company to return for them. So for this example, after counting the tax benefits of debt, this makes the cost of debt just 3%. So the company can use this as a way to determine if they should invest in a project. For example, WACC is 7.9% from our calculation, and they find a project that's going to return an estimated 6%. So then the company XYZ shouldn't do it. They would be destroying the wealth of the company since the capital they will be using would be costing them 7.9% and it would be earning 6%. So 6% minus 7.9% is equal to negative 1.9%. On the other side, if the project would earn 17.9%, then they should probably do that since they would be creating wealth. Has a cost of capital would be 7.9% and they would be earning 17.9%. So 17.9% minus 7.9% is equal to 10%. See how much of an impact this can have from a company perspective. If a company ends up to 10% return, that means that for every dollar the company invests in the project, 0.10% in wealth will be created for the company. Another good use of weighted average cost of capital is to use it as a discount factor in a discounted cash flow or some similar valuation technique. It works very similar to the way a company would use. We could use that number to discount expected cash flows to see what they're worth today. The cost of capital is affected by a number of factors. Some are beyond the firm's control, but the others can be influenced by its financing and investment decisions. The three most important factors that the firm cannot directly control are interest rates in the economy, the general level of stock prices, and tax rates. If the interest rates in the economy rise, the cost of debt increases because the firm must pay bondholders more when it borrows. Similarly, if the stock prices in general decline, pulling the firm's stock price down, its cost of equity will rise. Lastly, since tax rates are used in the calculation of the component cost of debt, they have an important effect on the firm's cost of capital. Taxes also affect the cost of capital in other less apparent ways. Let's say, for example, when the tax rates on dividends and capital gains were lowered relative to rates on interest income, stocks became relatively more attractive than debt. Consequently, the cost of equity and the weighted average cost of capital declined. So a firm can directly affect its cost of capital in three primary ways. First, by changing its capital structure. Second, by changing its dividend payout ratio. And lastly, by altering its capital budgeting decision rules to accept projects with more or less risk than projects previously undertaken. So first, by changing its capital structure. If the firm changes its target capital structure, the weights used to calculate the WACC will change. Other things held constant, an increase in the target debt ratio tends to lower the WACC, and vice versa if the debt ratio is lowered, because the after-tax cost of debt is lower than the cost of equity. However, other things are not likely to remain constant. An increase in the use of debt will increase the riskiness of both the debt and the equity, and this increases the component costs might more than the offset the effects of the changes in the weights and raise the weighted average cost of capital. So next, by changing its dividend payout ratio. So this suggests that the higher the dividend payout ratio, the smaller the addition to the retained earnings, and thus the higher the cost of equity and therefore the weighted average cost of capital. However, investors may prefer dividends to retained earnings, in which case reducing this said dividends. By altering its capital budgeting decision rules to accept projects with more or less risk than projects previously undertaken. So the firm's capital budgeting decision can also affect its cost of capital. When we estimate the firm's cost of capital, we use as a starting point that the required rates of return on its outstanding stocks and bonds. So these cost rates reflect the riskiness of the firm's existing assets. Therefore, we have been implicitly assuming that the new capital will be invested in assets that have the same risk as existing assets. This assumption is generally correct, as most firms do invest in assets similar to ones they currently operate.